Hi, I'm Steve Nicholson, Global Sector Strategist for Grains and Oilseeds for Rabobank. Welcome to Potato Expo. Welcome to the Potato Business Summit. And we're going to get started because we have a lot to cover this year. And the interesting thing about this year is that it's more about what's going on around agricultural markets and not necessarily what's happening within agricultural markets, although there's a lot happening there. But when you look at the story versus a year ago, where we are today as far as prices and what's happening in markets, we expect that prices will be very well supported as we get into the 23 year here. And a lot of that depends about a lot of different things. And we'll talk about that more, but let's jump right into the agricultural things. And I show you the cover of Million Baking News in December, and I want to read what the caption is up front. It says, "No one said this would be easy, but yeesh." And I think that's a really good summary of the year, is that this has been a tough year. The last 2 to 3 years have been tough. As the cartoon character is, yeesh, this has really been something. But I think it really sums up all the things we need to talk about, and they talk about on the cover. So we're going to talk about, of course, the macro outlook, and a lot of what we talk about will be about macro, both economic and agricultural, and then we'll talk about wheat, corn, and soybeans, and we'll do quick briefs on those as well. So let's jump in and right off the bat. This year I was thinking there's a lot of, within the agricultural markets, there's a lot of debate about, are we bullish or are we bearish? And as I said up front, we are still think markets will be very well supported price-wise this year. There's a lot of ifs though for the bears to make their case. And so I kind of laid out here in this chart, kind of the bulls and the bears. What are the bullish things? What are the bearish things? And what are the swing factors? And there's as many swing factors as there are, bullish and bearish factors. And the reason I bring that up is because when you look at the bearish factors, the bears are depending upon if the weather cooperates, if Brazil has a big crop, and if we have a recession and demand goes down. So I think all those things have to happen. But the biggest of all those things is when we look at 23 from an agricultural and from a price perspective is whether Mother Nature decides to cooperate this year and give us good weather to produce crops. But I want you to think about those and have, just so that you have an idea kind of where our mind is and what's going on. So if we jump into the macroeconomics and we look at the global economic growth, we can see that we've had a big spike down, we've had a big spike up, and now we're starting to come back down. The biggest challenge when we look at this going forward is China. And you're going to hear that more than once. China continues to be, the Walmart to the world, the Walmart from a demand side as well is the big player here. And China, has lots of issues when we see a housing bubble that's bursting, debt. Obviously, COVID has become a big issue. So you can see that COVID is going to have a real big impact upon China. And of course, the whole geopolitical issues around China and what happens to them. As that growth contracts, the big concern is they will not be demanding the food quantities that they had before. But I think you have to remember one thing, and we've talked about this before, is that China makes sure that they have to feed people. That's the most important thing for them. And so I believe that China will continue to be a big buyer. Obviously, they're buying a lot more soybeans from Brazil than they are us right now because the price is better. But as you know, that can ebb and flow depending on what happens in South America's crop and what happens with our crop and what prices do. So that's the big piece there. But you can see that we're going to see a contraction in global economic activity over the next year or so. So let's come back home and talk about the U.S. economy. As you can see, the U.S. economy, technically back in the first and second quarter, was in a recession. We had negative growth. We've certainly come back strong in the third quarter, 3.2%. Of course, the Commerce Department will come back and likely revise that, potentially down a little bit, we'll see. But we'll see the fourth quarter, the retail numbers at Christmas have been a bit of a mixed bag for everyone. So we'll have to see what the fourth quarter looks like. I think most people believe now that the U.S. will likely fall into a recession come the second half of 2023. But I will also tell you there are folks who are thinking that we may just fall into a very stagnant period where we just don't see much growth. We see growth that's maybe more back in that 1.5% growth rather than a more robust 2 to 3%. But the fact is that U.S. recession, and to quote my colleague Christian Lawrence, who's one of our macroeconomists, the United States is the cleanest shirt in the dirty laundry. Our economy is very strong, and we believe that we'll continue to stay strong as we go forward. One thing when we look at what's going back at home on the home front, real disposable personal income is really slow. You can see very clearly where those stimulus checks came in and how disposable personal income jumped. And you can see now it has really set back. And that is a concern for the economy when we look about what's going to happen with the consumer. Is the consumer spending going to slow down? We do know that their debt situation has gotten is back to levels we haven't seen since the Great Recession back in 08, 09. So that is a concern going forward, that could be a bit of a drag on the economy. And because of that, we see a relatively weak economy going forward. Not, as I said earlier, maybe not just a horrible deep recession, but basically a slower economy, weaker economy going forward. When we look at the federal funds rate, and that's always a lot of interest among farmers, is about what are interest rates doing. And you can see here very clearly that the Fed has been taking interest rates up. That's not a surprise. No big surprises there. And you can see that we're seeing a pretty big move up here. 4.25, 4.5 is where the federal funds rate sits right now. But when we think about that, and I want to show you when I show you that, look at the box I put in there. If you take the interest rate and you take the inflation rate, the CPI at 7.1% the last quarter, you still have negative interest rates, negative real interest rates. And that's going to keep investors somewhat interested in investing in the economy because they still relatively cheap money over time. So keep that in mind and not just, interest rates are up, yep, but still they're a good bargain as you look over time, over the long run. And I think as you talk to parents or grandparents who remember the 1980s and remember double-digit home mortgages, double-digit land mortgages, this is still relatively cheap money long term. As we look at the famous dot plot, or the infamous dot plot from the Fed, from the Federal Open Market Committee, you can see that in 23, there's a lot of folks, hovering over that 5% level. So I think it's very fair to say that the Fed more than likely, I think, is going to raise, and you look at the dot plot and think about where we are today, could see another 100-point basis up before we get out of 2023. And then we don't, the Fed's saying that they don't expect any easing until 2024 at this point. All that depends upon the labor market, all depends, of course, upon, with the labor market is still strong, also depends upon whether we go into a recession and what the Fed needs to do there. So those are the two things that the Fed will be watching very carefully and you should be paying attention to as well. One of the things that is a little bit of a cloud on that horizon about how do we bring this economy kind of down back to a more whatever normal is the money supply. Look at what the money supply has done. Over time, during recessions, you do see an increase in money supply as we try to promote more liquid assets in the economy to try to boost it up. But look back at the 1980s. This is when we look at it. In those two recessions, we only see a 1.6 and 7% increase in the money supply. Even in the recession of 2020, we saw only 11% increase in the money supply. But look at what happened right after COVID hit. The money supply went up over 200%. And we're still living with those high money supplies. That's also fueling inflation because you have a lot of liquidity in the system. And you can see that liquidity is slowly starting to trickle out. So that would be the other thing to be paying attention to, is that money supply trickles down and liquidity contracts, you're going to see less economic activity. I will tell you one thing to think about. If you talk to mergers and acquisitions bankers or M&A bankers, they will tell you that the last half of 22 was really quiet, and they're expecting 23 to be a little bit quiet as well because you're pulling liquidity out of the system. So one of the things to be watching very closely there. Finally, as we talk about inflation, we have to at least take a look at this. So here's the consumer price index for both the all urban and then less food and energy. You can see that we're starting to come down. That's the good news, and that will be the headline when you look in your newspapers or on the radio or on television, the inflation is starting to come down. But I do want to put one caution out there. Remember now, we're starting to compare inflation numbers versus a year ago. And so you are seeing a decrease, but the math is going to make that decrease seem bigger because you're comparing with a bigger number a year ago. So keep that in mind and don't get too caught up in the headlines, but actually, read the second paragraph of that story to find out exactly where we are. But so we are seeing a little bit of pullback, but let's not get too overconfident that we're really seeing a huge decrease in inflation at this point. I do want to show you the PPI versus the CPI. You can see the PPI has come down quite a bit. Usually the CPI, this is a very unusual one, other than what we saw back a couple years ago. It's come down a lot, and that's going to put a lot of pressure on the CPI. But again, we're still at 8% on the CPI, which still is a very high level over the last 40 years of data here. So keep that in mind well, but pay attention to that. So let's put the macroeconomy behind us and let's kind of move into what's happening in the agriculture economy globally. So I show you this picture here to show you the stocks of corn, wheat, soybeans, and rice around the world. All four are important agricultural commodities. And you can see that if you look at the stocks, we're in the top 10% of all time. And so it kind of leaves you scratch your head going, why are prices where they are today? And I'll get to that in a minute. You can see the stocks to use ratio is coming down. Stocks are coming down as well. That's part of the reason. So it's why I say that we're not in a food crisis, we're in a food price crisis. But the more important thing is when you come and look at the stocks of the major exporters of those four commodities, corn, wheat, soybeans, and rice, you can see that they are down substantially from their highs. And in the case of wheat, and now in the case of rice, you're starting to see multi-year contractions in stocks. And I always remind folks, if the exporters don't have it to export to feed the world, then you really will have a food crisis because you won't have those exporters there. Now, a couple of things to remember, when you look at wheat stocks, 54% of the wheat stocks in the world are sitting in China. If you look at rice, 25% of the world's rice stocks are sitting in India. So keep in mind, they may be, and Russia has a lot of wheat as well that's not moving out as quickly as we'd like, and we'll come to that in a minute. But the fact is, we're not seeing that wheat or that rice or that corn or the soybeans, particularly wheat and rice, not trading like we'd like to see. And the chances are they're not going to come back. And when they're in the hands of China, they're very tight hands. In the case of India, we know India has also been very quick, as has Russia, to put on embargoes for exports because they want to try to either stem inflation at home or to try to do something politically. So keep that in mind, and this is going to keep markets, as you can see, stocks are levels they haven't been for a number of years. And if you look at stocks to use ratio, it's even more dramatic. This is going to be very helpful or very supportive to prices as we go forward. I show you wheat stocks in specific. So this is the same chart you saw a minute ago with the major exporters of stocks. And you can see now we're in the sixth consecutive year of reduction in stocks. So there's two lines on this. One is the dotted line, which is Russia and Ukraine exports. And you can see they're sort of flattening out. That's sort of the good news, bad news. But if you look at the dark black line is the exporter stocks minus Russia and Ukraine. And you can see that the exports are above the stocks of the remaining exporters of the world. And so that tells you one of the reasons why wheat has been has had such a radical or a lot of volatility to the upside and the downside is because the rest of the world doesn't have enough wheat to make up for the loss of Ukraine and Russian production and exports. So keep that in mind and what's happening globally, that this is going to have an impact on wheat going forward. I'm going to quickly talk about the U.S. because you see this a lot. Obviously the U.S., same situation. We see declining wheat stocks, declining soybean stocks, and corn stocks relatively stable. I will tell you, I believe that corn stocks will be down year over year as we go forward, even more than they are now because of the demand side, and I'll talk a little bit about that later. There's the stocks to use ratio. You can see for corn and soybeans, very, very analogous to what we saw during the mid-2000s. Wheat is getting there. So again, supply is not keeping up with demand. And so that's going to keep, again, be very supportive to prices as we enter in 23 and through the 23 growing season here in the United States and Northern Hemisphere. So let's switch gears a little bit and talk about Russia and Ukraine. I show you this chart so you get an idea of what ports are working and what ports, and those are the ports that you see that have a big circle around them. Those are the ports that are involved in the Black Sea Grain Initiative, which is the grain agreement that Russia, Turkey, Ukraine, and the UN put together. We're in the second term of that, has a 120-day term and still working. The good news is I think the trade's been very surprised at how well this particular grain initiative has been working. And we're seeing movement of grain, which is the good news, and I'll show you that here in a minute. One thing I will say, I want to point out the point of Constanza in the bottom left-hand corner. There at the Danube. I will tell you there's a lot of investment in the Danube, and you're going to see more investment in the Danube because it gets away from the Black Sea. The one other thing I will talk about too is when you look at these ports, and this is the concern that's right now coming up, is that as Russia continues to bomb Ukrainian infrastructure, particularly when you think about energy, that's bad for the ports because the ports either won't have electricity, they won't be able to work full time. And so these are all issues that will continue to go onward that we'll have to worry about and will keep markets very volatile, particularly wheat and corn as we go forward. And as here you can see Ukrainian exports over the last 2 years. And that's, Ukraine in November, this is the numbers we have so far, 4.7 million metric tons, very similar to what they did back in 2021 crop year. Certainly below the levels of the 21-22 crop year, but the good news, the Ukrainians have done yeoman's work as far as getting the crop in the ground, getting it out, and trying to get it out into the world market. So we have to give them a lot of credit and hope that continues going forward. But as you know, their window of exports is closing soon because they typically have exported through that kind of the fourth and the first quarter are their big quarters. And now we're starting on the downside of that. So hopefully this will keep up because the grain initiative is in place. I show you this map so you get an idea to see where are the other opportunities for Ukraine to export. Remember I mentioned Costanza down there in the southwestern part of really Ukraine, in Romania, there at the Danube. So we see a lot of trucks, a lot of rail going that direction, but we also see rail and truck going north into Germany and into Poland to move stuff out into the Baltics and out into the world market. And there's been a lot of investment both by the US and also the European Union in trying to help the Ukrainians to modernize their logistics system so that they can move more grain or have more options than just the Black Sea to move their products to market. So that's a good news going forward. Last word on this is, and we talked about investment, this is going to have a long, long tail. Is this war going to be over tomorrow? Nope. It's going to be over next week? Nope. It's going to be next month? Probably not. This is unfortunately going to drag on. But the fact is, because you've had this war and buyers have said, you know what, I need to be careful. I need to diversify my supplier base. And so you start to see that. I think that's part of the reason Russia has had issues in exporting grain. They've had some other issues as well. But I think buyers in the world, when you ask them and say, well, are you still trading in Russia? You get the yes, but. So I think that's something we need to think about. And that will be investment in other parts of the world, invest in the Danube corridor, and investment in other ports and other infrastructure in Europe to move Ukrainian goods out of Ukraine in different ways other than to be so dependent upon the Black Sea. One of the other questions we've had a lot about, and it goes back to the discussion I had earlier about demand, is about, well, what happens if we have a recession in the United States and what happens to demand? So I've overlaid this, and I'm going to go through this quickly. There's three charts here: corn, wheat, and soybeans, and looking at domestic demand versus recessions, which are the gray columns, versus the price. And I think a couple things to think about. When you look at the gray columns and look at when we had US recessions and look at demand for our commodities, they typically don't go down. We don't see big changes. Now we do see changes when we see high prices, and you see that it's kind of a delayed reaction. Like it may happen this year, but it may happen next year as we see these high prices and buyers, run out of cheap grain and they have to re-up. So I think that's something to be paying attention to. But I will say one thing to think about the high prices the last 2 years in the United States and look at exports and you look at demand, it's still been very, very good demand. And I want to show you, I'll show you a chart a little later looking at demand. So here's soybeans, very similar sort of picture. High prices have more impact than a recession has. Here's wheat, just so you get an idea. The wheat situation is much different because the U.S. is usually a reserve on the export market, and if our wheat's very high price right now, as you can see by the line, and so it's not very competitive in the world right now. Russia's becoming more competitive. So, but you can see food demand still there, feed and residual still there, although it's going down a little bit. That's a challenge of the feed market, and the seed stays pretty flat. But I also overlaid this over the price charts. And you can see when you look at recessions and look at prices response, you can see it's a mixed bag for wheat. Sometimes it goes up, sometimes it goes down. But I will tell you, when you look at corn and we look at the corn chart, you can see very similar sorts of things. We see ups and we see downs, but you can see it's a very quick down if it's a down move, and it comes back very quickly. And you can even see within recessions, you can see that down move, and by the end of the recession, the prices come back to where it was at the front of the recession. So I think the recessions will have very little impact or very quick impact on commodity markets, and they'll come back very quickly. As we move and talk about into 23, when we talk about acres going forward, you look at corn and soybean acres almost on par with each other. We do see wheat acres up close to 50, about 48 to 49 million acres in 2023. The high prices are certainly encouraging that. But it's also, we need those acres because we don't know what we're going to get production-wise because of what Mother Nature's done for wheat. So cotton acres are flat. That's been the big challenge, and one of the things we've been seeing challenge among minor crops is to attract acres, because corn and soybeans are very easy to produce, and they're very profitable, and farmers will make rational decisions as to where they want to plant, where they want to put their money to get the most margin or most profit for their buck. We do want to talk about, kind of on the same punt, talking about margins and talking about profitability. When we look at producer margins for 2023, we still see producer margins positive. Now this is a corn-soybean rotation in the Midwest, but when we start looking at wheat, we also see the similar situation. It's yes, input costs are up, and we do see that, and we personally acknowledge that, as you can see in the charts, but also keep in mind the revenue side. The revenue side is up as well, and so the market is giving you opportunities to lock in some profitable margins, and we certainly encourage you to do that. You know, you're now in January, you're getting a much better idea of what your costs are going to be for 23, and you still see high markets. Take advantage of them. The market is giving you several opportunities. That's been both the case for buyers and sellers. Give you opportunities. Take advantage because you may not get that opportunity. The volatility is your friend, so be aware of it and take advantage of it. I do want to mention quickly, and there's a lot in the big thing I want to talk about, the Farm Bill's up in 23. That will be debated. It's going to be a very interesting year because you have a split House and Senate. The Senate's likely to take the lead because the Democrats, you know, that committee's still in place. There's a much more bipartisan working relationship in the Senate on the Ag Committee than the House. The House, as we well know, is going through a lot of convulsions these days as they try to figure out leadership, as they try to figure out, you know, where does everyone land. And so I think that the Senate will be taking that leadership, but there's bound to be a lot of fireworks. Certainly the nutritional program will get a lot of attention. We also think climate change will get a lot of attention, but we don't know where that'll go. And then also the farm law will make sure the crop insurance stays in place. But the one thing when you see these pictures, there's a lot of people want to have their hand, and it's only getting more people, not less people, in making of a farm bill. So as we always say, as is always said in Washington, you know, you don't want to watch how the sausage is made because it's going to be a tough year. So be paying attention to that. Make sure your senator and your congressman know what you feel and what you think about the farm bill. And then to finish the macro section, to talk about what does 23 look at. And we've talked a lot about that, and we've talked about the weather, we've talked about the economy, we've talked about demand growth. You know, is it there, is it not there? And I'll show you a couple of graphs that shows it still seems to be there. And I think the thing that I want you to take away from this, and governments are more involved, you have more geopolitical entanglements, and you have sustainability, climate change policy coming down the line. While we know all of the factors within the agriculture, there's a lot more factors that we haven't dealt with for 20 or 30 years outside of agriculture. Government intervention, central banks, climate change, all that is coming our way. And so we have to be aware of it and really stay on top of it. So a lot more, that's going to be volatility, both on making decisions, volatility in prices, that will be there, we have to be paying attention to. So keep that all in mind as we go forward. Now we're going to talk about specific commodities. So let's start with wheat, because that's certainly the biggest rotational crop with potatoes. And I think that's the one that we need to focus on most of all. So I put together kind of this dashboard looking at stocks to use ratio versus price, stocks versus price, change in stocks versus price. And you can see that all the pointers, or all the prices are moving up as we see stocks reduce, stocks to use ratio come down. And we 6 years of reduction in stocks in the US. And I think this is a real challenge. And I don't think we're going to see much change in this. We'll see a lot of volatility, but we are going to see wheat prices be well supported going forward. I show you the conditions chart just so you get an idea of where we are. Yes, this is always can be argued it's a flawed chart, but it's the only thing we have. It's what the trade looks at. And when I look back over a number of years, on more than 2 or 3 decades of conditions on winter wheat prices, this was not good. This was the worst on record that I have found. Now, that doesn't mean that once we come out of dormancy and it starts to rain and everything is okay, but we go into dormancy with lots of challenges. We went in dry, very shallow root systems, very cold. It's been very windy in the Great Plains. How much of that wheat is going to come back up? The interesting thing, we were in the Ohio Valley, Western Kentucky, Western Tennessee, where there's a lot of soft red winter wheat, and it looked good there. And when we talked to farmers and asked them, how is your crop? They're very concerned about how dry it is. It says it looks good, but it is not when you start walking the field and get out there, you do not see the tillers, you do not see the robustness of the crop that you'd like to see typically that time of year. So keep in mind, this is not just a winter wheat story, it is also a hard red winter wheat story, it's also a soft red winter wheat story. I do want to just show you just the charts of the stocks. When you look at the stocks of all the different classes, you can see everyone's contributed to this down graph. Mostly hard red winter wheat because of how dry it's been in the southern plains, but you can see everyone's been a contributor to this, and it doesn't look like that's going to change anytime soon, and it's going to be difficult to see 2020. I think in the best case scenario, we'll look at 23, 24, stocks will be basically flat with this year, and that'd be the best case scenario at this point. So we finish up wheat. Here's what we see on our wheat acres outlook and also our wheat price outlook. So this is the Farmgate all wheat price outlook. 75% probability that prices will be $9 or below. That's how you read this chart. I'm looking at the green dotted line. And you can see when we look at acres, 75% probability that all wheat acres will be 49 million bushels below. And you can see those are relatively flat over the 10-year baseline. Prices for wheat do start to come down, but you can see that they're still above $7. And as we have moved this, and this is the case for corn and soybeans as well, as we've done our baseline over the last 2 years, and we kind of update every 6 months, we see that price range continue to move higher. So let's move to corn real quick. That's an important one for everyone. Same dashboard level looking there. You can see, stocks are low relatively to history. You can see stocks to use ratios come down a lot. You can see the change in stocks and what price is done with there as well. The demand side of the balance sheet, and I need to talk about this because this is where I think we have to talk about the demand side. When we talk about corn, we talk about wheat, and we talk about soybeans. And we talk about the demand side, and a lot of people point, you'll see USDA is taking demand down, but I think part of that is because you've had shorter crops than expected. You've also, and the USDA is just trying to make that balance sheet work if you have it. And so they're taking demand side to try to make sure that stocks don't get too low. And my concern is, or my feeling going forward is that USDA, and we've already started to see this in beans, we've seen this a little bit in corn, we've seen that in feed and residual, start to see the demand side ratchet up a little bit, not a lot, but a little bit. And so we see stocks contracting a little bit more. And I think that's the pattern we're going to be in over this year, is that the demand will come back up a little bit as we go a little bit farther into the year and stocks get a little tighter. So keep that in mind as we go forward, and don't get too caught up in the fact that demand is crashing and that this is going to be a bad year and that prices will fail. High prices certainly have an impact, but as you look at the demand picture for corn, you look at this, you look at prior to the 2000s, basically very inelastic. Price was X, didn't really matter what the price was, this was the demand side. As you move post-2000, mid-2000s, and look at what that curve has gotten a little more elastic. So as prices move up and down, or as quantity moves back and forth, you get a lot more reaction in the price. And you can see, and I could argue that we have seen the curve move up to the right again, higher demand, at higher prices. And this is a very interesting dilemma. How does the market deal with this? But it tells me, it's one of the things we've thought about and talked about as a research group, as price become less material because you have to have it to feed people globally. So something to keep in mind and keep on your radar screen. I'm going to finish up here with barley and corn prices. You can see barley stocks very low. I think that's, again, this is a chart, looks very similar to what we've seen in the other charts. Barley prices at very high levels going forward, so keep that in mind as well. And then if we look at corn acres, we do expect corn acres to be 75%, probably they'll be under 90 million acres or less. When we look at the corn outlook price, we see 75% probably the prices at the gate will be $6.75 or below. So again, a relatively friendly price scenario for corn. Let me run through beans really quick and we'll finish up here. Same chart for beans, very similar sort of chart looks. Lower stocks, higher prices, lower stocks to use ratio, higher prices, that very similar pattern as we go forward. The big news, and we should talk about this for just a moment, is talk a little bit about South America because it's certainly going to be important for our markets here. South America, Argentina, as you well know, has been very dry and people are continuing to discount the size of the soybean crop there. I think now we're down in the mid 40s, I think 45, 46 million metric tons, where I thought it would be 49, maybe even 50 million metric tons this year. So you can see, and that's happening each month as we go by, and each week we see a reduction in numbers. We go to Brazil, different story. Northern, central west Brazil looks pretty good, but southern Mato Grosso and southern Brazil has been very problematic. It's been very dry, and we see a situation there where we're starting to see problematic as far as yields. So the good news is, though, for the world is that the crop got in a good time. That means the safrinha corn crop will be planted on time, and so there's a potential there to see a good crop going forward. But I think we have to be aware of that, the season's not over, and so we could see some volatility here in January as the weather progresses in Brazil, both to the upside and the downside. Here's the bean situation. You see beans have gotten a little more inelastic. in that it doesn't matter what the price is, they're going to take, depends on what the demand is going forward. Price is somewhat a little less than material as well. But you can see, you wonder about 22, 23, still high price, but we're still taking near record demand on beans around the globe. I will say, when we look at this chart on feedstocks, and this is a whole nother 2-hour presentation, but when we look at soybeans and what's happening in the vegetable oil market, the demand from the biofuel sector, whether it's biodiesel in South America and Southeast Asia, or whether it's renewable diesel in the United States or in Europe, the demand for vegetable oil is tremendous. And you can see here the uptick in demand for these for the biofuel sector. And this is coming about as we see new crushing assets come on. For those of you who live in the northern plains and northwestern corn belt, that's where most of that is going to happen. So Nebraska North, Nebraska, Kansas, and the Dakotas are seeing an increase in crushing capacity there. So be aware of that. And that's going to be changing some of your basis levels for soybeans, as it will change the acreage patterns in that part of the world as well. When we look at that demand, that crush demand, we're expecting nearly a 30% increase in crush demand across the United States. The big challenge will be what to do with all the meal. So when we look, and one thing I also want to talk about is renewable fuel standard, the RFS. Here's what the EPA put out. The market reacted very negative to that. That's another kind of a 15-minute conversation, but the reality is we're still getting an increase in biofuel mandates around the United States. So that's going to be supportive to markets going forward, at least for the next 3 years, as we see what EPA's put together here going forward. So with that, I'm going to stop, other than with here's the soybean outlook. You can see that soybean prices, or soybean acres, around that 90 million, about on par with corn. That's because of the crushing capacity we see growing, and we see that the crush capacity is going to attract a few more acres. But you can see going forward with those acres, we see a little bit more downdraft in soybean prices. But again, 75% probability that soybean prices will stay at $14.25 and below at the farm gate. It's still a good price as we go forward. So with that, I will stop. Thank you for listening. Thank you for watching. And hopefully we will see you again next year. So Happy New Year.